Happy birthday to me. Happy birthday. Oh, hello. Good morning. Good morning. How are you? Well, today is ICT's birthday. Not when Michael became ICT, that's November 5th. The actual birth date of the man himself, Mr. Guru. August 8th at 7:11 p.m. tonight. 52 years ago, I entered the fray. So, hope you're all doing well. Let me just start off real quick with the live stream yesterday. I kind of went off on a rant, and I don't apologize for it. So let me just make that very clear. I don't apologize for it, but I think those in the seats that have control over what's going on these live streams, I think they let me know that I was giving a little too much opinion about certain things. So we're gonna avoid that because my stream was disrupted yesterday. So to avoid that happening again, we'll just have to leave it for another medium. So anyway, today on the economic calendar, and today you can take this one to the bank, we will be shutting down at 9 o'clock. It is my birthday, and I do have plans, and my wife basically laid down the law and said 9 o'clock or else. So gentlemen, you know what that means. I have to make my escape here at 8:59, so that way I have met our arrangement and agreements before I started the stream today. She was a little disappointed actually was going to be doing it at all, but I was like, yeah, come on. I gotta go out here and hang out with my people. Okay, so we're gonna look at this morning's price delivery. If you've noticed on the, let's see here, get my cards out of the way. Yes, I still hold a deck of cards when I'm talking to y'all. I don't know what's going on with YouTube. I can't see anything to check it or test it. So I'm going to go over to my personal private group real quick, if you just give me a moment. I just want to get a check on my audio before I go any further, because I've done live streams before and thought I was talking and could be heard, and it wasn't picking up anything. And I've also done videos where I've recorded for hours and come to find out I wasted my time talking. So okay, my personal private students are letting me know they can hear me loud and clear, so I don't want to see any comments saying turn up your mic, get better equipment, because you need to turn your volume up or use headphones. All right, so at 8:30 today, the economic calendar gives us employment data. Okay, so it's not non-farm payroll like typical, first Friday of the month. It is something that is ahead of those numbers. Oh, I'm sorry, not ahead of those numbers, but it's related to that information. I don't care what the number is. I never look at those numbers for any report. I don't look at the number for CPI. I don't look at PMI. I don't look at the non-farm payroll numbers. I don't compare the trends of what all of that is all baked in. Okay, it's all baked into what price is going to do, and I just want to hunt where I think it may reach for. Okay, so you're probably looking at the charts, especially the one up in the upper left-hand corner, the 15-minute time frame, and you probably noticed that there's a whole bunch of lines on it. Okay, and for a chart that is an ICT chart, that's very busy. Okay, it's a whole lot of stuff going on, which is what I was referring to yesterday when I was talking about how you want to create a layout. And I also want to say something real quick. TradingView, I think, was a little upset with me. One of the representatives tapped me in the private message of TradingView. Usually you see the messages over here on the right-hand side. I think he was letting me know that I disclosed too much information about it. But I really didn't disclose anything except for they offered an opportunity, and I've been true to everyone else. every vendor, every brokerage firm, every prop firm, every person or entity or company that's ever asked for some kind of a partnership with me, I've always declined it. Because if I do that, if I do a program or an affiliation with anyone, that means my opinion is influenced, period. And I don't trust anyone's opinion that has an affiliate or partnership monetarily with anyone or any company, because they're monetized. Their opinion is monetized. So when I say something, and I haven't said anything bad about TradingView. In fact, you're probably all going to be buying a membership to TradingView on Black Friday. So they should be thankful that I'm pushing and hurting everybody. But that's the day everybody should buy it. And it's not my fault that they heavily discount their stuff on that day. I just wish I would have done it like that the first few times I paid for it. But don't bother me, dude. Okay, I'm repping as best as I can because I like the service. Don't nag me in the private messages. So anyway, the lines you see here, this is kind of like what I was getting at yesterday, where you want to start populating your chart with, you don't have to go back in time. You can just start doing it walking forward, which is essentially what I have here. I just picked the Sunday new week opening gap, and that's as you see up here. And I'm going to take you to the chart where it actually is formed so we can see it. And then this is how I recommend that Caleb labels his. Okay, so while it's not important to have these on the chart you're watching, all day long or minute by minute, or if you're looking at a chart like a less than 1 minute chart, 15-second, 30-second chart, it's not important to view it from this perspective, because once you see where you're at, like for instance, we're here right now. This is mark to market there. That's real time. And we are just below Wednesday's new day opening gaps low, and we are above today's new day opening gap high. So we're in between, okay? Which is classic, it's typical because we're waiting for a medium high impact type of event at 8:30. Now, when we do not have high impact or medium impact news in the morning session, I still am watching these levels because at 8:30, the element of time is still there. So the algorithm is going to just walk forward. It's not aware. Okay, and this is kind of like me saying probably too much more than I should, but this is why I say I don't care about the numbers that these reports, present to the public, because at 8:30 the algorithm is going to start spooling anyway. Okay, on high impact news drivers or medium impact news drivers, they can push it a little bit further. I'm not saying that it's absolutely 100% manual intervention, but they will loosen it up a little bit so it starts to reach for a little bit farther outside the normal band of volatility, where it can go up a little bit further than if it was without a news driver that would be either medium or high impact. And what am I referring to if this is the first time you're watching? If you go to forexfactory.com, I don't have an affiliate with them either. I don't have anything with them, but they have a calendar that I've always used. When I was on Baby Pips, I used that calendar, and when I was teaching Forex and price action through Forex, that's the one I would use. You can still use it, but I prefer Econoday, and that was the one I was using a long time ago. And it's a little bit harder on the eyes than the real nice presentation that Forex Factory does. It's a real cleaner, easier, and Econoday gives you a whole lot more information that I don't personally think you need everything that it shows, but if you want to be a completeness freak, like you just have to know everything, Econoday is the better economic calendar. Okay, and it's free. You can go to their website, and there it is. If there is an absence of medium or high impact news in the morning session at 8:30, I still am watching 8:30 because the market will in fact still spool. Because it does that, I'm already looking at 8:30 anyway because it's a key time. It just makes it better, more probable that we'll have a lot more volatility, and the price runs will be a little bit more energetic when we have a medium impact or a high impact news driver that's due out at 8:30. Now, At 8:30, when we have something like we have today, this is classic where we'll be sandwiched between just waiting for that news to hit. Everybody that wants to play breakouts, okay, they're going to want to be a buyer, maybe above this high or that high. Short sellers are going to want to sell short here on a break below those levels or above those levels, respectively, because they don't know what they're doing. I'm suggesting to you that we have to sit and wait, because it's not in an area where any one particular direction is more likely than the other. Let's say it that way. So let's go through a process of, this is what we're practicing. We're looking at a time when the market should start running in about 7 minutes or so. And then we want to watch and see how price reacts and delivers to. I'm going to scroll back real quick and show you where the new week opening gap high, the consequent encroachment, which is the midpoint between the high and the low, and it's labeled, as you can see here, okay? And then here is Tuesday's new day opening gap, which you get that on Monday at 6 p.m. Eastern Standard Time. And then here is Wednesday's new day opening gap high, midpoint, new day opening gap low for Wednesday, which you get on Tuesday at 6 p.m. Remember, the 6 p.m. opening price gives you one or the other, the new day opening gap high or low. And wherever that 6 p.m. open is, if it's above where it stopped trading at 5 p.m. that same trading day, then that's going to mean we have an up gap or opening gap higher. And the higher reading would be your high, or your new day opening gap high. And then where we closed at 5 p.m. for that 1 hour break, if the close is lower, then that would be your new day opening gap low. And then you put a fib and measure the difference between both. And that 50% level is your consequent encroachment. So it's your midpoint. You don't need to put the quadrants on it, okay, like I was teaching yesterday. After a while, you'll just trust the fact that you can eyeball it. You don't have to be so precise about those levels. I like to do the quadrant levels when there's a larger range, okay? And this particular range, this is one where I would have the quadrants on. If it's a smaller range, like say the new day opening gap is like 10 handles or 15 handles, something less than 20 handles, I'm going to eyeball it. I'm not going to worry about the actual specific levels, because we're talking about very little in terms of separation from where a trade might be entered and where a stop would be. It's not going to be an impact to me for making or breaking a trade. But this is a significant range here from 18,099 to 18,033. So we have 66 handles or so in here. So that's a pretty significant price range. So you would want to look at the quadrants, and you simply would just, when you put the fib between the high and the low, that makes up that new day opening gap. And if you don't know what I'm talking about and you didn't watch yesterday's presentation, go back and watch it. Okay, don't skip ahead, because you're going to watch the video and be frustrated. You have no idea what I'm talking about, or assume that I don't care that you are trying to learn it properly, because I've already outlined it yesterday. But when you put the fib on the low and the high of that gap on your Fibonacci, you're just going to toggle 0.75 or add it into your settings, 0.75 and 0.25. So it gives you your quadrant levels in addition to the 0.50 level, which is the consequent encroachment. So you can see where everything is anchored. Here, 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 but I want to scrub back and show you where we opened. So here's where Friday's trading closed. And then here's where we opened on Sunday. See that? And then measuring the distance between the close on Friday and the open on Sunday at 6 p.m., your 50% level. Now on new week opening gaps, same thing. If it's a significant new week opening gap, I want to put the quadrant levels on. Okay, so I'll do that here so that way you can see it. This level was dropped in, so it's not a fib. You can see that. So that's how I keep the chart clean. And that's what I'm suggesting to you, Caleb. All I'm doing is when I put the fib on, I'm measuring the open to the close, and you can see it's the same price level. So 451.75. Let's take that Fibonacci off. 451.75. And all I did was drop the horizontal line, which is this one here, and put it on that price. And if you have to calibrate it, you just drop it in close proximity to it, and then coordinates, you just put the price in, 18,451.75. And then if you have to move it around, you just do these types of things here. So that way it's sitting either below the high or just above the low. So that way it's closely correlated. So that way you know what you're monitoring. But to get the quadrants, when it's an opening gap like that, these are the settings again, real quick for clarity's sake. You're going to have these in your Fibonacci settings. So if you toggle them 0.75, 0.25, that'll give you your quadrant level. So I'm adding them now so that way you can see. You think that's random? You think that's random right there? Some of you I've already mentioned to me either in an email or a direct message to me on my cell phone, and I've asked you politely not to do that. My phone's been buzzing since 11 o'clock last night with everybody wishing me happy birthday. While I appreciate that, you can just as well do it in the comment section on a most recent post on the community tab on my YouTube channel, because that's like the replacement for Twitter. So while you don't see other people commenting, I see every comment that's made to me. Anything rude, I broom you. I don't never need to see anything from you ever again, because I frankly don't care about your opinion. You're either here to learn or you're not. If you're not here to learn, piss off. So we spike through it. The wicks do the damage, and then we come back down. Look how it hits the bottom of the new week opening gap there, and then accelerates lower. What is it reaching for? Well, you have Tuesday's new day opening gap there. It trades into that. Look at the consequent encroachment of that level. Bang. And then we come back up, hit the low of it, inside of a fair value gap, trades lower. Here is the Wednesday new day opening gap. Look at the bodies respecting that. You see that? The wicks are going to do the damage. Okay. And then we have, look at this, completely random, comes back up, consequent encroachment, trades lower, one more time, drops back down. And now what have we done? 8:30, we traded up to Wednesday's new day opening gap low, consequent encroachment, high. See if we can hit it. Just a little bit more of a spike. There you go. So what I was talking about yesterday, when we're looking at price, how do you learn to trust where the market's going to gravitate to? Okay, like what side the market's going to reach for. Do you remember what I told you that you're going to focus on? If you've taken notes, you should already know this, because it's basically staring at in front of you right now. If the market's here, okay, and we have only today's new day opening gap, which is here, that's below opening right before 8:30, before the run that's on that news driver, where are you seeing clustering of new day opening gaps and a new week opening gap? Where do you see it? Is it above the market or below it? Smiling, aren't you? Look at it. You have it above, you have it above, and you have it above. Plus, we've already had a nice drop down. We've taken liquidity, relative equal lows, inside of a buy sign of balance, sell sign of efficiency, right there. Here, let me show you. Background, border, and we'll extend it to the right. Okay, boom, trades down to upper quadrant of that fair value gap, which is a buy sign of balance, sell sign of efficiency. Okay, let's just put some juice on this a little bit. Think that's random? you think that's just random? It's buying pressure there, guys. Don't you understand? It's buying pressure that turns these markets right on a dime. Somebody collectively tells everybody in a Reddit thread that we're all going to buy at that price. So anyway, the price comes off of that, comes back down. I like the fact that we didn't come down and touch this because that sets the tone for it's trading up to these levels. Okay, it's going up into these levels for the sake of offering the equivalent to fair value, because all of these levels here are potential areas for engagement for deeper pockets. Okay, and that means that they could, I'm not saying yet, but it could be going up here to create just a little bit of excitement to lull or lure in buyers. And then they take them against the calls and come back down and work in today's new day opening gap again later in the afternoon, or maybe during the 9:30 opening. While I won't be with you and I will be with my wife, I will be admittedly peeking at my phone, watching at 9:30 to see what we're gravitating to. Okay. New week opening gap. It's going to take a real move to get up there, and that would indicate something entirely different that would probably put me on the sidelines until we get to like 10 o'clock. Like, if in other words, if we run up there, if we start to really expand up in there prior to 9:30 opening, I would absolutely wait until 10 o'clock silver bullet, and that would be my setup. And I would worry about taking a trade only around that premise, not something, before. Like, usually I'll have an expectation in the marketplace where I think it's going to gravitate to this or that level. And if it's above, that means I'm going to be looking for some scenario where I want to see a shift in market structure that's bullish. Time of day, I want to trade inside of a macro. That's the last 10 minutes of the new hour about to begin, or 10 minutes after the top of the new hour. So I'm hunting that type of setup, and those conditions are not there yet for me. But I wanted to sit with you today and have it on the chart and kind of like prove to you, like, this is when you're talking about support and resistance, okay, and you're looking at books like Technical Analysis in the Financial Markets by John Murphy, or any other classical retail textbook. Those are absolutely helpful and useful because it gives you what the other traders out there are going to be trying to do, and they're going to try to risk money on those ideas, these archaic ideas that have actually no bearing on what price is going to do. The concept of support and resistance is, in my opinion, too myopic, and I've lost a lot of money trying to trade them, because the idea is it goes to an old high, bounces down, and then if it goes up there one more time, the idea that going back up here and touch it again, to me, as a trader with the perspective I have now, is why does it need to go back up there if it's going to be resistance and it started to drop the first time it touched it? Then there's really no weakness there. It's going back there for a reason, right? It's going back there to go above it because people are short and they put their stop losses above that. And it took years for me to figure that out, because I wasn't someone that would want to sell short, because I was afraid to sell short. I was only trying to buy if I was trying to trade. So when you look at how the market trades around these inefficiencies, these actual gaps, and then because they trade to them and fill them in, everybody else in this industry, before I started teaching like this publicly, they would never worry about those levels again. It was completely tossed out. This got rid of it. It was no longer a factor for them when they would look at price action. And I'm trying to tell you that you don't want to do that. You don't want to do that. They have a life cycle of a high degree of sensitivity that, in my opinion, to serve you as a student, new day opening gaps, you want to have at least the last 5 days, okay? And the last 5 weeks if it's the new week opening gap. And if you have these levels on a layout, you'll be able to see, okay, at the time at 8:30 when we were first talking, I mentioned how we're in between two significant inefficiencies. So nobody can sit there and say, well, it's a so-and-so entry pattern because of this or that, because it's in like a no man's land. But as I was teaching you yesterday, how can you determine what side it's going to push through? And why would it do that? Well, if you're sitting and watching the market, 8 o'clock is when you're looking for relative equal highs and relative equal lows. and into 830. And then at 830, what are we doing? We're looking for where is the stacking and clustering of these inefficiencies, the new day opening gaps and the new week opening gap. If it's above market price, which is right here at 830, where is it most likely going to press into? The side that has all the inefficiencies, even if they've already been traded to. See, this is what I'm referring to. Like it's already crossed over this gap here. It's already touched the low of it here and dropped. This one here, we went back and forth inside of it and left it, came up constant encroachment to the low. Well, that means it's done, right? Just toss it out the window. It's already been used up. It's stale now. That's what you're going to think that, like anybody else would if they saw a gap fill in. Okay, well, that gap's done. Let's go look at something else. You don't want to do that. You absolutely don't want to do that, because the algorithm, this price engine that pushes price, it's driven by these reference points. So what the algorithm does is it calls back to these points of reference based on time and price. What prices? The prices I showed you. What locations on what date? The ones I'm showing you here and what I taught you. And what'll happen is you're going to learn to anticipate which direction the market will push to before it happens. So the next stage in your understanding would be, if you're expecting price to reach up, why? Because you have a new day opening gap here, a new day opening gap here, and a new week opening gap up here. And we've already dropped down into a very deep discount relative to the price run from down here all the way up to what we did as a high on Wednesday. So we've dropped down. We're in a deep discount here. It rallies up, and then we're waiting for that news driver to come out to wreck retail, because they're going to try to play the breakout game. They don't have any idea what side the market's going to reach for. And the way you build confidence and trust in your trades is you have to do these types of exercises. Notice no button was pushed. Notice there's no trade idea. There's no worry about a stop loss. There's no worry about how many contracts to buy or sell, because you have to do this drill for weeks and months to overcome that fear of, I'm going to get it wrong. How can you trust it? The things I'm teaching you, how can you personally trust these things outside of my word saying it's good stuff? You should take my word for it. I'm telling you, don't take my word. I don't want you to take my word for any of it. I want you to test it yourself, because you already see it's valid. The logic is there. And if you can't see that, you're denying it, or you didn't pay attention or take notes. Because this is the exact thing I outlined yesterday, where you see the new day opening gap, new day opening gaps, plural, and the new week opening gap. It's above where market price was right before that high impact news driver at 830. So what does that mean? Well, let's say it like this. If we would have seen price drop down, okay, and there was a much cleaner fair value gap in here, not the inversion fair value gap that's right there. If it would have had another cleaner fair value gap here, and if it would have dropped down initially at 830, that would have been a potential for us to say, okay, we would expect it to drop down to that fair value gap and then expand up and reach into these gaps here. And maybe, look real close, there. Why there? Well, if you look at the range from this high, I'll fix that in a second. It's always in the wrong place. Has that ever happened to you? This box always pops up right where I need to be adjusting something. So here we have the high, down the low, and where is that? 50%. There it is right there. 50% level there. So above this level, we have this gap here, which is what we've already traded to. But this one here, I like that one because it's also inside of a breaker. See that? Now, if we're using this reference point, do you remember what I taught you about the breakers? What did I teach you about the breakers? I'll give you a minute. Let me get a drink real quick. It should be in your notes. if you have a breaker, which is a high, low, higher high, that blows out the buy side liquidity, during the run up, if you have a fair value gap in there, that's the one you want to focus on. And you don't want to focus on just the down close candles that make the last bit of turn before the rally up, because this is technically your bearish breaker here. But if you have a gap like that right there, that one could be a potential inversion fair value gap. So you have to highlight that and extend it over. So we have this PVA right here, the breaker, and the potential inversion fair value gap that could draw price up to that. Meaning that what we see here, this was indicating the likely direction it would trade up to. And you have to appreciate in the beginning and not punish yourself or tell yourself, this isn't doing it. I'm not making any money doing this. This is foolishness. You know, there should be a button being pushed. There should be a stop loss recommended or something like that. You don't get to that level with confidence, being able to take the trade and hold on to a trade and not get scared out of it or put a stop loss in the wrong place until you do these types of things. And you have to do it daily for weeks and months. And then you overcome that fear of, I don't know what it's going to do, but I'm willing to press the button because I see somebody on a live stream or ICT talked about something. He talked about a specific level. That means it's going to go right there right away. No, that's where my interest is. And I want to then look for evidences and signs in price delivery that it's going to probably reach there. But the first step in you determining the direction or bias, Caleb, is when you're looking at when the market's about to move, which is 8:30 news driver. Even if there isn't any news, you still look for these same signatures here. It just means that if there's a high impact or a medium impact news report due at 8:30, then it's going to be a much more significant, more the magnitude of the move and the speed of the move will be that much more prevalent because there is a high or medium impact news driver. If there is none, then we'll just start to see price just start to move up to these levels. Okay, it's not 100%, but out of 100%, you're probably in 80% or higher. That's the right direction initially. So if you're a scalper, if you're looking for something to get in there and just make a run on some movement in handles or in Forex pips, this is what you do. Okay, you look for these types of signatures, these evidences that the market is going to want to do this type of thing, and it gravitates to it. It's like a magnet pulling price there. Okay, so I just want to real quick add these things on the chart just as lipstick. I'll do this. And we'll do this. Whenever you see a fair value gap that's highlighted in this shade of orange, that's my way of reminding myself as I'm talking to my son, or you if I'm in a video, or if I share a trade. You should already know that I'm viewing that as an inversion. So if the market creates it as a buy side imbalance, sell side inefficiency, and it rallies up, for someone that just watches a 5-minute trainer video from somebody else that watches my stuff and thinks they understand it, or watches me do something with a concept of introduced, they'll think, okay, well, this is, when it drops back down here, that's a buy. No, it's not. No, it's not. All we did was go up into the new week opening gap, traded at a high, wicked through it a few times, doing the damage, and then we displaced lower. That's not a buy. Okay, so with that, we can now go into where's my lower charts? There we are. Let me maximize this one. So here's a 15-second chart. And I know some of you don't have the ability to see this real time. But here's 8:30. Right there, bang, it opens and quickly runs in 15 seconds. The market travels from 17,986 3/4 to 18,089. Huge amount of displacement. And if you don't know what you're doing and you're gambling, that type of run, especially if you're trying to do these funded account company challenges and they're offering you a maximum of 5 contracts on their lowest thing, and your risk is maximum of 3,000. Don't hold me to these numbers. I'm just trying to remember what Cameron and Caleb were having to deal with when they were trying to do these things. But I think it's $3,000. If it's not, it's something close to that. But they offered, like, you can trade with 5 contracts, or on the larger ones, you can trade with 15 contracts, and that's guaranteeing you're going to blow out. And then you have to pay a reset fee, and they don't have to pay you out anything because you failed. So you just keep paying the transaction fees, and that's how they make their money. Well, on the 15-second chart, we can see it runs into Wednesday's new day opening gap, Tuesday's new day opening gap, and then we have this fair value gap that is above equilibrium on the price run that's dropped since Wednesday's high. And here we have price rally up, come back down. Look at the overlapping of this candle's high, and the next candle we open, we trade down. Where does it trade to? Consequent encroachment on Wednesday's new day opening gap. You see that? That's this level right here. It touches it right there, and then rallies, leaving what? A fair value gap. What kind? This is a buy side imbalance, sell side inefficiency. So if it's likely to keep going higher, because it's going to dig into this one and maybe reach into this level, we don't need to know it right away, but because we have this potential new day opening gap we can draw up into, there's range between trading on this fair value gap being repriced to, and how far can it overshoot this gap? We'll look at the overlapping of here, where this body and this body agree. The top of that one and the low of that one. That right there is a PD array. One of the 81 that supposedly I don't have. It can touch that perfectly. What's the open on that? 18,081 and a half. What's the low on that candle? 18,081 and a half. Perfect. Perfect. And then it rallies. What does it create? Small little volume imbalance inside of, and real close to what? What's between these two levels here? Buy side imbalance, sell side inefficiency. So we want to see it form support or an inability to trade to the midpoint of it, or if it does, it needs to repel it immediately. That looks like this. See, every time I do that, it jumps. There. So here's consequent encroachment at that buy side imbalance, sell side inefficiency. We trade down to some random quadrant level. See that? And then what does it do? It rallies. This is good. This is good because it leaves this volume imbalance open, and it doesn't come back down to the midpoint and starts to rally. Then the market creates every little down close candle needs to support price, because that means it's acting as a bullish order block until we get above here, and it does, and trades to the high of that new day opening gap on Tuesday, which you derived that information from Monday at 6 p.m. and the difference between Monday at 5 p.m. to closing price. The market trades back down into down close candles here, just outside of the Tuesday's new day opening gap low, hammering around back and forth inside here. If this falters and fails and goes below this candle's low, to me, stand aside until 9:30 opening. Don't try to Mickey Mouse and play games with it, because it'll probably hurt you. Trying to figure out what this level is here. I'm not sure what that is now. Oh, it's the midpoint of the overall range. I was like, oh, what is that line? It's the measurement of that high on Wednesday to the low of yesterday. So let me get that up because it's distracting. But while you have these levels in mind, and when they're in close proximity, you want to have these on your chart for trade purposes. You don't have to have every single one of them on your chart that you're going to operate on. So again, as I was mentioning yesterday, you want to see them on a layout that you can refer back to that's outside of your operating trading layout. So over here, like where I have live trading, this could be labeled as new day opening gap template. Okay, or it could be new week opening gaps and new day opening gaps. If you want to have a lot of stuff on your chart and you're comfortable with navigating all that, you can put them both on there. I personally don't recommend doing that, but I'm affording you your own personality to be implemented here. So I'm not trying to say this is the best way to do it. It's up to you how you want to annotate your charts. I'm just saying that this is how I'm coaching my son to do it, so that way his charts will look easy to me and understanding what he's annotating, because it's something I've instructed him to do this way. So that way we're not trying to make it harder for me, because I'm a little older in cantankerous now, being 52. So here we have a potential immediate rebalance. Oh, yeah, my bones are telling me I'm 52 today. All right, so the initial run from 8:30, unless you were already positioned long from early on and you're just using it for a momentum run, like trying to get to a higher time frame objective above the marketplace, your ability to get in the move, when it moved like 100 handles in just like 15 seconds, you're not going to be able to pull that off. Okay. Using the ideas I just outlined when we were in the 15-second chart, that's the closest thing that could have been implemented for me, and I'm ICT, so that's the best I could have pulled off using the information that, as I taught yesterday, that draw would be deciphered and determined based on where the market was at right before the news driver hits, and then that means I have more probability that the market's going to expand higher. Why? Because I taught you yesterday. Go back and listen to it again. If you didn't listen to it, go in and listen to how I explained. If you start looking at a chart or a layout that has these new day opening gaps, and you start seeing clustering above it, above wherever you're at, waiting for a setup to form, when? Between 7 o'clock, 8 o'clock, and 9 o'clock. Well, we have a sweet little cherry on top with the fact that we have a news driver today at 8:30. So that means the attention and focus is going to be where? Is it going to be in the first 30 minutes of 7 o'clock Eastern time? No. Is it going to be ahead of 8 o'clock? No. It's going to be right at 8:30. Why? Because the economic calendar is your TV guide to the next important event to watch on TV. Okay, so we're watching price like television. Our interest is peaked when? At 8:30, because the news driver is going to happen. And that volatility that will be introduced, why? Because the market is going to spool. It's going to run real quick. Look at your time and sales data at 8:30. Look at it at 8:29, at 8:28, 8:27, 8:25. How much buying was taking place there? How much buying took place in the run up in this just one single candle at 8:30? You're not going to see an exorbitant number of contracts. It's the fact that it's being repriced there aggressively. So how's that happening? The price engines, that's an algorithmic artifact. It's something that is driven by automation. It matters not how many buying of the asset or contracts, or if it's a stock, it doesn't matter how many shares are being bought. It's going to be pushed up there. And then when it's at these lofty price levels, then it's your task to see, does it justify being there? And if there's reasons to see it sustain a run higher, then you don't look at anything that would otherwise look like a reversal pattern. You cancel that out and you look for continuation, which is very, very hard to do when you're brand new. when you look at runs like this, it's hard not to feel like, okay, I'm looking at indicators and it's all these divergences bearishly, so I'm afraid to do anything going long. And when you're brand new and you don't know anything at all, that's why it's important to not have any opinion. So the only thing you can do is, in the beginning, you annotate your chart as I indicated for you here, and then you study it and you watch it and you observe. And when you see things that are interesting, you screenshot it and make a quick note. You have to have a pad and a pen or pencil next to you, and you write down, the screenshot I took at 8:57, on the 1 minute chart. What was your concern there? There's a fair value gap here. It was like a buy side imbalance, sell side inefficiency. And there's a fair value gap a little bit higher in price. Is it going to go into this and then propel up into this level here? Is it going to do that? Is it going to do it before 9:30? Or does it want to retrace and clean up these relative equal lows, disrupt that, and then run up there? Or does it completely fall out of bed and trade back down into this imbalance here to the low of Wednesday's new day opening gap? See, these are all questions when you're brand new. These are all things that you can study and you have no monetary risk involved. And by doing these types of things, it desensitizes yourself to needing to be right in the beginning, because you're not going to be right. You don't know what you're going to see. You're learning. And by watching price do these things day after day, week after week, for months, you're going to pick up on things that I've talked about in lectures, but it didn't mean anything to you because you haven't saw price action repeat. You haven't seen it repeat, rather, over and over and over again. And then it means something to you. It resonates with you then. Whereas right now, you don't know what it's doing. You don't know what to expect. If I had nothing on my charts, it would be completely alien to you. You wouldn't have any idea what's it trying to do. Why would it have gone up here? If I wouldn't have gave you that lecture yesterday in the live stream, you could not sit here in agreement and say, yeah, this is what you said yesterday. This is what it will likely do. And this is what it did. Okay. So now what do you do with it when the market has already traded in a manner where it has then set up the likelihood that if it's bullish, okay, if it's going to likely press into an area above the marketplace where you're watching price form a potential setup. In other words, the key times when you're hunting a setup. What happens if it would have done something where at 8:25 it had dropped down into a fair value gap, and then going into 8:30, what would have been potentially available to you? You could have traded into that news data as it dropped down into the fair value gap, buying that, anticipating this type of run. But because we were between two new day opening gaps and there was no real inefficiency to think of in terms of trusting it, yeah, you had a bias that's based on what I taught yesterday that it would likely go higher. But as a new developing student or trader, you don't want to gamble on that, because you're really just saying, okay, I want to test this theory, and if it's good, I'm going to make money on it. But you have to understand that if you're testing this and you're observing it and you're doing practice drills with watching price action, tape reading it, you're not even demo trading it. There's no paper trade execution. You're teaching yourself to trust your anticipatory price reading skills. Reading price, anticipating that it's going to behave a certain way. You can't rush this part of it. You got to watch it, see it, and this is the part of the walk forward. So 3, 2, and 1 lecture of this mentorship is basically the back testing, how to log, how to look for certain things and observe how the market behaves. This is what you're doing when you're walking forward. So that way, if you're a little bit further along in understanding, you don't have to go at the snail pace that I'm forcing Caleb to go through, because he doesn't have this skill set strong enough yet. Nowhere near where most of my students that have been with me for a while, they could read price action better than him. Just because he's my son doesn't make him better than the majority of you. He really isn't that good, but he's making an effort to get good at it, so that way he can make money and carve out his way with actual trades and not rely only on his income. So This is like again, like this lecture and Friday's lecture again will be all based on walking forward, what you're supposed to be doing, what you're supposed to be looking for, how to weigh out factors that will help build a routine or guidance that helps you refer to it as a process or procedure. This is what we do every time we sit in front of the charts. We start like this. We look for things like this, and then we take the experience of watching it, logging it, and when you do that, what are you doing? You're making price action the same thing as if you went out and bought a brand new Aston Martin or a new Rolls Royce Ghost or Wraith or Lamborghini or Bugatti or whatever car that tickles your fancy. Suddenly your eye is keyed up on that car, and when you see it out in public, if someone else has it again, you'll say, wow, that's my car, or that's like my car. They must have bought one when I bought one. And it's just because now you've made it significant to you. You've opened up your mind and activated your reticular activating system, meaning that you've added significance to this. You've added significance to reading price when it makes these certain things or these characteristics. And therefore, because you're journaling them, you're continuously adding significance to the importance of understanding what these formations at the time of day that they form. What do you think is going to happen when you look at a new chart when it's ticking real time? You're going to notice you're going to notice your car, right? You're going to notice your setup, your pattern, the thing that you have built affinity for and around because you have spent time caring about it by journaling. Now, if you're just going to sit back and have an attitude that has, yeah, I know it's 4 minutes after 9. I got to get this part out entirely, and I'm gonna hope my wife's grace is a little bit more lenient because it's my birthday. But I have to make this point. The fact that you're watching price and you're journaling it, not just looking at it blindly like a deer in headlights, confused and scared and wondering what it's going to do, and or not pressing the button to try to chase a price run, you're looking at it with the intent purpose of logging things that are important to you that you want to study and see if it pans out, and you're noticing how fast the price runs move. If they fail, what did it look like before it fails, and how much does it run against you before it delivers to where you studied to see if it can reach for? Now, I have this fair value gap up here, and it may not get there. If it doesn't get there, I don't care, because the idea of the lecture and the thought process behind yesterday's teaching delivered like gangbusters today right in front of you in a live stream. The side of the marketplace that I gave you the rules on yesterday, the guidance, that process and protocol delivered today. There was no reason to enter beforehand because it was not in an area where it could be trusted. And there wasn't any drop down right before 8:30, which would have been a little bit more indicative of, okay, that would be where I would trade. I would trade in that because I anticipate the market wants to trade up into these inefficiencies that have already been crossed over by price action. So again, we're not doing supply and demand. We're not trading support and resistance. We're trading old reference points in inefficiency for the express purpose of seeing it engage and liquidate traders. That's liquidity. Where has the money been made? Prior to 8:30, where's the money been made? Being short. So if there is a huge bias to the market wanting to reach up into where the new day opening gaps are and a new week opening gap, what does that mean? The pain is going to be placed on the shorts, and that means the market's going to rally. You may or may not have an opportunity to get involved in it, and when it starts off as it did right before 8:30, that's one where you just simply have to wait, and you drop down into a 15-second chart, and then you trade the inefficiencies and or the first order block that will support that idea. In this case, it's likely to go up into the Tuesday new day opening gap, which it's done. It's working above it here. It still might fail. It still could very well fail and go down back into Wednesday's new day opening gap high. Perfectly reasonable. It could still do that and then still trade after 9:30 and trade up to here. It could do that. So all these things come with experience and weighing out, okay, what's the probability? What time is it right now? It's 7 minutes after 9. Is that conducive for a significant sharp price run when you have in 22 minutes or so the opening bell, where you're going to have that initial volatility, and you have the opening range of 30 minutes that could easily trade all the way back down here and give the impression that it's completely failed and fallen out of bed, and it could never go back up here to this high again, and it could rip their face off for anyone that tries to fade that. So there's a whole lot of, it's like, I've said it before when I was doing Twitter spaces and other lectures too. It's many times like plate spinning. And it's usually where a guy has a dowel rod, a wooden dowel rod, and plates, china plates. And he spins the plate on top of this single dowel rod. And he has like 20, 30 of them going on the stage. And he has to constantly run around to the ones that are starting to slow down, and he don't want anything to fall and break. That's what you're doing in the beginning. You feel like a plate spinner because you're trying to find the end that's profitable, but you don't want to break any plates in the process. When I'm telling you, it's like making an omelet. You're going to have to break some eggs for you to understand how to make a good omelet. You're going to have to break them, and you have to screw up a few times, and that's where your learning comes from. And see, in the beginning, you're thinking, I got to avoid losing. That's success. That's winning. I have to avoid doing it wrong. Otherwise, I'm going to fail. And I'm telling you, you have to fail in the beginning to see what you're doing wrong and not look at it as a way of, oh, I'm never going to get there. I've failed a lot. I've done a lot of things in the beginning where I thought for sure this was going to be the thing, and that indicator didn't lend me anything but more drawdown. I would try a new study method, or I would follow somebody that was hot and important back then in the 90s, and I would lose money. With Larry Williams stuff, I tried to do his 1-900, his calls for the S&P and the bond market, and I would lose money. I personally couldn't make it work for me. That's all I'm saying. And does that mean that he didn't make money using it? No, it just means that when I tried to use it for myself, I couldn't make it work. So because of that, I didn't stick with it. I would do a couple weeks and that was it. I wouldn't do anything with it. Basically, what most of my students, when they first come here, they listen to the lectures, they hear me talk and cheerlead them on. They like, hey, this guy can really talk a good game. I'm inspired. I'm going to go out there and run out there and get successful. And then they realize, oh, this is kind of boring. Like this is not all that exciting. And I got to do all this. Man, there's got to be an easier way to make money. And then they start looking at people that have indicators or signal services or whatnot. And then they do the very thing that I did when I was 20. My impatience got the better of me, and I just wanted to make money. And I'm telling you, that's not how you do it. It sounds counterintuitive and counterproductive, but you have to do these things here. And then once you get the skill set and knowing that you can trust yourself and you can read price action, no one can take it from you. If you make a mistake, or if you do a trade incorrectly and you made it public, they might troll you for that trade, but that doesn't strip you of your ability or prowess to be able to do it again and profitably and mitigate that drawdown and make new equity highs while they're still trying to figure out what you're doing to make money, and they're miserable and they're going around to the next person. As soon as you win, they're going to go to another person and troll them because they're miserable, because misery loves company. So when you're watching price, you're trying not to think about the highs and lows emotionally. If it goes down here, that'll be demoralizing. I wasted all this time watching it from 8:30 to now. This is like 45 minutes almost, and the market's just sitting around here like this. Well, that's what trading's like, folks. Just because you want to make money and you eventually pass a funded account, it doesn't mean the market's going to say, okay, well, Shirley has put her time in, so we're gonna run real quick for her because she's in a trade, and she deserves it. So let's just all work towards making this fast and painless for Shirley. Shirley needs to get a fucking grip, because that ain't how it works. This is a long, arduous task where you're just going to sit there and watch candlesticks meander around and then eventually go against you or go in your favor. And what you're doing every single candle is you're watching and weighing out, does it support the narrative that I underlyingly chose to get into as a trade? Is it still giving me indications that what I would like to see pan out, is it still potentially there? As long as that is in play, you don't think about the opposite side. Why? Because your stop loss would do its job. You're paying that stop loss to protect you. If it trades to a specific level that you don't want to be a part of, if it goes beyond that, you're gonna pay for that stop loss to do its job, which is get you out at a loss or at open profit, where you're willing to say, okay, I don't want to give more open profit than this. If it goes to this level, I'm probably wrong, and that means I'm okay with being wrong, but now it's at a point where I have to make a decision, and I don't want to be focused on that decision every 5 seconds while the trade's going on. So you have to use a real stop, not a mental stop, because it will make you mental. When you lose 20, 30, 40% of your account, when a market move comes and you didn't expect it, it blows you out, and you didn't have a stop loss, you're mental then. You're literally going to go crazy, because it's a simple thing. You place a stop loss. Place it. Place it. Not using a stop loss is guaranteeing that you're going to fail. Eventually, given enough time, that outcome always comes with failure. That means blown account. That means back to square one, or you're completely not going to do it ever again. So I'm looking at that volume imbalance right here, and the fact that we came down and touched the top of the Tuesday new day opening gap high. So we have 2 little PD arrays inside of this order block there. So I want to see, does it want to make a run for the high here and start squeezing towards that fair value gap up there? It's already done enough for me today where I can go peacock in front of my wife. I told him yesterday how to look for it, how to determine which side it's going to run for, and it did it beautifully today. And when you start seeing in the beginning, I gotta text my wife and tell her I'm gonna be here until the opening bell, and she's gonna yell at me with emojis. Give me a second. Hold on. Dear honey, love of my life, my sunshine in the morning, how much do I love you? I will be down. Come on. I'll be down at 9:30. Who's your daddy? I'm gonna get smacked on that one. All right, so when you're watching price action like this and walking forward, you're observing certain things. Anything that would make you feel apprehensive, anything that would make you feel that would second guess your expectations on what you think price might try to do. Whenever you have that in the early stages, okay, don't shun those concerns. Write them down in your chart after you screenshot them, okay? But you want to write that real quick, briefly, inside of your notepad, because you have to have a notepad and a writing instrument when you're watching price. And you should do that while you're actually trading too. But if you have something that is a concern for you while you're watching price deliver, mind you, in the beginning, you're not even demoing it. You're not pushing a demo entry. You're not trying to pick an entry point. You're not trying to know with great certainty where your stop loss should be. Those are questions that need to be answered later on. The initial stage of your development is sitting in front of price action and watching how it behaves. I promise you, 99% of all the instructors and mentor wannabes out there that are trying to sell mentorships or teaching you stuff, they didn't do this part very long at all. They went right into trying to demo and trying to demo and trying to demo, and then doing funded account challenges. And how much money did they spend on funded account challenges versus how much money they've withdrawn? If it would be really interesting to see that compare and contrast for people that do mentoring, if they do that kind of stuff. What would be the difference? What's the split, the ratio between that? I think it'd be probably illuminating. But instead of trying to be the next teacher, okay, because some of you want to learn how to do this, that way you can do mentorships and make a lot of money too, and have all the tax breaks and benefits of that trading doesn't afford you. Learn how to just be a good trader. And the way every good trader gets there is doing the boring part of what we're doing here and what I've been talking about the last 3 sessions. If you don't have the tenacity and to say, this is boring. This is not fun. I'm not making any money with this. But I know that this is absolutely the way I'm going to get there, because I will know by experience that there's absolutely no reason for me to be fearful of a move that doesn't pan out. Because I've seen many times where if I watched and waited for certain things to present themselves in price action, the probabilities get shifted so much more in my favor that it's going to happen, versus that if I didn't know these things, how would I know it otherwise? And then what you do is you end up coaching yourself and encouraging yourself, which is what self-talk is. Self-talk, you want to do that to yourself while you're watching price action by yourself. You want to say, okay, you're doing good. Like it's reacted off of that volume imbalance and that order block and touching the top of that new day opening gap from Tuesday. Otherwise, other people would have never noticed it, never concerned themselves with it, because the gap filled. Well, here we are. It's, ICT's birthday, and his stuff still working days after these levels were formed. So my question to you is this: how many times do I have to come out here and prove this stuff theoretically, logically, and it delivers to the perfect again? Like, think about it. See, some of you need to see me push the button as long as it goes down in that volume imbalance, and use a stop loss that would be right at the rejection block right there on that close. That's where your stop loss would be. So what's the risk between that and getting in at the high or the open of that candle, which is the volume imbalance, inside of that order block right there? Devil's advocate, you can be worst case scenario, use the opening price of that order block and say that's your fill, and your risk is the close of that candle. You're watching this level here. It could have wicked below it by a tick, but that's about as much as I would have expected. Why? Why would I have only expected that much? Because it's already filled in this volume imbalance there. Two bodies. This body's inside that volume imbalance too. And then we had a wick in here that went below that. There's no need for it to go back down below that except for one tick. How does ICT know how to put these stop losses real tight like that? How does he know? ICT's stop placement is top tier. You're fucking right it is. Because there's logic behind it that you're learning here. And you have my son to thank for it, because he's the one that wanted me to do this for him. And he wants it documented. So therefore, the things that I'm teaching him, he'll tell you, I'm not talking to him about price action in texts. I'm talking to you right here. Everything I'm doing in front of you, he's watching it just like you are. And I do this every single day. Every single day. I know what it's going to do. If I don't know at the moment when I sit down, I'm going to wait for more information, and then I know what it's going to do. Now, if you are someone that watches this and says, well, that's all well and good, he got lucky. What's it going to be like when we're 5 weeks into this and it's still panning out? Is it still luck? Is it still luck? Where's my lucky rabbit's foot? No. It's this boring logic that repeats all the time. And you want your trading to be boring. You want it to be boring. You want it to be a monotonous task where it's just so redundant, just like your job. But yet you still find your ass back there to get that paycheck, don't you? You'll drive and sit through traffic, have other people cut you off and cuss you out, brave through the weather, just to go get that little ass paycheck and deal with Carl. Well, if you're willing to put yourself through all that bullshit, what's keeping you from doing this? It's something simple, some kind of head up your ass syndrome that you got to pull your head out of your own ass and say, you know what? This guy has the goods. He's got people all around the world proving that they're making money. You see the students' names on the payout. You see them. You go onto those funded account places that shows you who's getting paid out. And then watch their videos when they say, yeah, I did this. This is how I'm making money. There was a time that they were thinking just like you. Oh, this guy's full of shit. You never see him get out here and trade a live account in front of people. You're never going to see him call the market live. What's going on right now? I'm giving you the logic the day before it does it. And then after the fact, I'm telling you, okay, now watch this. I'm watching this volume imbalance right here. It's come down here. Now I want to see, does it run up here and reach into that? Now, because it's done this ahead of 9:30 opening bell, what does that mean? Well, on a day like today, I would wait because I got to run from here to here. That's a pretty sizable run. What is it? Almost 100 handles? Let me make sure if I say too much. I'll just use the opening price on the order block. That's our hypothetical entry, okay? So 173. And we're aiming for consequent encroachment. So consequent encroachment is, we'll say 250. Did it get to 250? 252. Okay, so 250 from 173. So 80 handles. We're there, about 70 handles. Something like that. I'm 52 years old today, okay? I'm having a Biden moment. You can do the math. It's better than every other YouTuber that live streams, let's put it that way, except for my student Tanja that killed it the other day, making over 130 handles. I watched you, girl. Don't think I ain't looking, okay? I'm watching you. Just because I'm quiet doesn't mean I don't have your live stream on. I'm watching what you're doing. The takeaway is today, because we've already pressed up one-sided and we've done all this business in here, remember I was saying that how most people would look at this and feel like it's petering out, and they may be second guessing, like, okay, is it gonna behave? Is it gonna act like resistance or bearish divergences? Because if you're watching indicators, it might trip you up and think, wow, this is really running out of momentum, and it's probably going to go back down here and fill in this liquidity void. No. It's drawing up to areas of inefficiency. Why did I highlight this fair value gap? Remember that? Why was that even highlighted? What did I use? The same stuff that I taught in my private mentorship lectures that are on my YouTube channel for free. Stop paying people for mentorship stuff that I've already laid on this YouTube channel for free. For free. And it's there for you to watch it anytime you want. But this is formed on my wife's going to kill me today. My birthday present, honey, is leniency. The warden, I'm asking the warden for leniency. Please be lenient with me today. I'm in my moment, okay? I have to do this to my completion, and then I'm satisfied. Because if I leave it and I don't say what I want to say, I won't be able to enjoy my time with her and my family, because I'll be thinking about this because I'm obsessive. This guy's a real jerk, man. He's putting trading before his wife and kids. That's been my whole life, and that's why I'm not the best mentor. So we have the low of this candle and the high of that candle, and the single pass through at sell side delivery. Inefficiency is on the buy side. That means until this candlestick here, that high, the difference between that and this candle's high, that is your inefficiency still. Okay, so it looks like that. And what does it do? It trades up just above that on this candle there. But why did I pick this fair value gap? Why did I do that? Well, if you go back and look at where we were here before 8:30 started to run up, I measured in front of you this high, dragging the Fibonacci down to here. The only use of a Fibonacci for me is I want to know where the midpoint is. That's all Fibonacci does for me, because that determines if it's overbought or oversold. I don't need an indicator to tell me that. You don't need an indicator to tell you that. And divergence on any indicator is useless. It doesn't mean shit, because you're compressing numbers. And if you beat and torture numbers enough, the data will submit to anything you want it to say. So it's a matter of looking for where are we at in the range. So can you see clearly that this is the range high? all the way down to that low. So the most recent large degree of directional movement, right at 8:30 as it happened, where was the profitable trades being held? The longs or the shorts? Predominantly it's the shorts. Why? Because it's been the most recent protracted directional move and it's been going lower. So when we have these big ranges like that, it's important to measure with the fib. That way, if you're going to go long, or if you're anticipating it's going to go long, why would we anticipate that? Because what I gave you yesterday as guidance, I'm gonna slap you around a little bit and you say stuff like this. I got to get it out of my system. But 50% is here, so that's equilibrium. So at that level or below is discount. At that level or above is premium. So we're here at 8:30. I taught you yesterday that if there's clustering with the new day opening gaps and a new week opening gap, if that's above where the market price is and you're anticipating price to have a movement one directional, okay, or high impact or medium impact news drivers are likely to create a spooling in price where they start gapping price higher. And you see that in that 15-second chart where it traversed over 100 handles in 15 seconds. And you think that's buying pressure. It's not. That's absolutely algorithmic. It's them repricing. Now, before the markets were electronic, there would be a group of men that sat around and they would pair orders. If you remember back in times where I was teaching on baby pips, they're pairing orders. What does that mean? All they need is one trade, one contract to book price. That's it. So if they have an intention of repricing to 18,165 when price is sitting at 17,973 and it wasn't electronic markets, so the algorithm was all future. They can't do it yet because it's not automated yet. We don't have the technology to do that. So everything's open outcry. What they would do is they would sit in a room. One man would put an order in, okay, I want to buy at this price. And another guy would say, okay, I will agree with that price. And they hurry up and they stair step it just like that. And that would feed that price run. So that way the price would book on your chart before electronic trading. And they just kept prices moving just like that. And you can see it, you can validate it with volume. Just look at volume. How many contracts were traded at 8:30 to make that 100 handle run? When I get done showing this again, I'm going to drop down into like a 1 second chart, and we'll look at that first 8:30 to 8:31 movement with a 1 second chart. It's illuminating. So because we have equilibrium here, and I'm anticipating based on the logic I taught you yesterday, if the market's here before the news driver is going to be the retail's excuse for why price went up when it's not. It's just the highlighting of the time when the market's going to start spooling. Spooling is just like when you have a fishing rod, okay? And you put your little anchor, your little sinker on the end of it with your bait and your hook, and then you cast the fishing rod out into the water. The fishing line, when it starts leaving that spool, that reel of fishing line, as it's going off that reel, it's shooting off, but it's being unraveled real quick, and it's shooting out the length of the fishing pole and out into the water. That's exactly what's going on when the algorithm starts running. When it enters into a buy program, boom, it starts spooling higher. When it enters a sell program, boom, it starts going lower. Your task is to understand the characteristics when the time is likely to see that unfold. When there is no market driver, when there's no news, like at 8:30 or 10 o'clock reports that come out, or sometimes there's a 9:45 number or 10:30 if it's crude oil inventory. When you have all those reports or those times of the day, they're pretty generic. Everybody knows that. But there also are things like I taught as a macro. It's the first 10 minutes before the top of the hour and 10 minutes after the top of the hour. The market will spool there as well. It'll start running. What is it running for? It's running for liquidity or rushing to get into an inefficiency. You probably hear Bailey in the background barking. I apologize. I think it just got a delivery. And thank you for the birthday cards, by the way. There's too many of them to show. I showed one of them, Moses. Thank you again. But I just don't. I know some of you probably would like to see your stuff show up on my community post. I don't want to do that. But that day I just got one, so that was nice. The fair value gap that I chose here is above the equilibrium price point. Okay, and it's also inside of that breaker. And if it's going to trade above this, where could it trade to as an upside target? This area here that could act as what? The inversion fair value gap. So it's those levels we look for. Okay, so how can we use this information in a trade idea? Let's go back down and get this Fibonacci off. Let's go into a 1 minute chart. All right, and then when price had this big run here, that's not what I want to do. Let's go into a 15-second chart. I apologize. Look at the reaction off the low of that fair value gap there. It's probably random. Don't pay attention to that. It's all selling pressure. The balancing between this candle's body and then open and trading down here, that makes this from this low to that high. That's a balanced price range. What? Yeah, that's balance. That's balanced price delivery. Both directions have been offered. It's from this low that we don't know yet is formed yet, but it's also the same low that makes the consequent encroachment of Wednesday's new day opening gap. See that? So all these things are converging. This run away from that and then close. We open, trade down to that consequent encroachment, and then pass through and leave that high there. That means that this high is a balanced price range down to that low, because between this candle's low and that candle's high, price has been offered up and down. That's balanced. That's balanced. And the market trades back down, and you see them hitting the closing price here and digging into this candle's open. Hits it perfectly, rallies. On a 15-second chart, you can use order blocks as your entry, small fair value gaps, volume imbalances. I love them if the direction's still in play. Okay, and we were outlining this level here. So anytime you see a convergence of a new day opening gaps, low, high, or consequent encroachment level, and a down close candle and you're bullish, it leaves it and comes back down in, you can use that as your catalyst to study price. Does it behave and run to your objective? I gave you the objective today. I outlined how the market will behave yesterday. So I pointed out the volume imbalance. I pointed out the fact that we came down and touched the top of the Tuesday's new day opening gap. And then we want to see, does it rally up and go into this fair value gap? And we got that. Okay, 70 plus handles, if not, whatever that is, on a very small run, but after the major damage was done. So I used the logic in front of you. We didn't touch market replay. To do that, you got to do this. Okay, you see how that changes the bottom of my screen down here? My screen never looks like that. It never looks like that, because ICT knows what the fuck's going on. I don't need to use no market replay to guess, oh, let's start watching and going forward. The hell with that. It's dumb. Okay, dumb. I want to leave this. Yes, I do. So that's why my chart looks like that. Okay, even if I maximize it, I don't think you can pull up market replay when you do that, can you? No, you can't. So there you go. That's why I show my screen maximized. I go through all this to prove to you that all this stuff is happening in real time. The market's open, countdown to close of the candlestick. I mean, it's all there. But there are specific things that you're going to find that they're real signals that you want to participate in. There are setups that are more likely to pan out than just looking at, oh, well, it's trading down into a down close candle, so it must go up. No, there has to be other contributing factors to it. And when you're looking at things that are outside the candles, a la new day opening gap, new week opening gaps, the separation between those price levels, which is event horizon, those types of things, they're like dark pools. They're things that the general public are not privy to. They're not something they can reach for and say, oh yeah, this is, they're looking at indicators. They're trying to overlay stuff on their chart and looking at mathematically crunched data, thinking that that's what's going to cause the market to go up and down. No, the only thing that's doing is providing liquidity for people that use that logic, and they put orders in the marketplace based on that bullshit. And then we go in like a cannibal and devour them. And they don't even know what just happened. And we're going to go back the next day, do the same thing all over again. And as long as they have money in their account and buttons to push to do so, and we'll be cleaning their clock again. And that's the life cycle. Stupid money, street money, dumb money being cannibalized by smart money. And smart money uses these concepts. Look at what the market's doing. Consequent encroachment. I told you this level before it happened. It traded up to it and then hits it here. So what is it indicating? It's having resistance, right? It's having a hard time. And then it breaks down. This level, or that low, after it touches this, trades down below that low. What does that mean right there? It's a shift in market structure. So what is it going to do? It's probably going to trade up to a short-term premium. What's it going to trade to? See that gap? See it? There to there. What's the bodies over here respecting? That. But the wicks are allowed to do what? The damage. How far can it go? Well, do you see the volume imbalance right there? These are all things that you annotate and screenshot as price is doing what you're watching. And what does it trade down to? Some random bullshit NDOG, some horseshit. It's all made up. It's all make-believe. I renamed this from something apparently. Find a book. Find the VHS tapes and courses that talks about these new day opening gaps being used like I taught. It ain't there, folks. But guess what? It's all over on Amazon right now. It's on Amazon right now. And it has my logo somewhere in the book, or my name on the cover of the book, ICT's Inner Circle Trader Secrets, blah, blah, blah. And they're teaching it through ignorance. They have no idea what they're talking about. The only thing they're doing is parroting what I said. And that's why people that leave me notes and stuff, you talk too much, because that means they got to listen to all that shit or try to condense it. And they failed in school. So they're trying to do, you know, with John Fibolotti did, make a book with a bunch of bullshit, and it's all my stuff, but supposedly credit everyone else. It has nothing to do with them. It's because he wanted to do a cash grab. Until I put a review on there. Come to the YouTube channel and you'll see this guy's a liar. That's what you get from the multi-level marketing gurus, 20-year-old rip-off artists. Hits it, fails, volume imbalance, fair value gap. The takeaway is this. When you have a fair value gap and you have small little cracks in the delivery of price like that, little tiny volume imbalance right there, this tells you where the wick can go, but how can you trust the trade is still viable? Or if you miss this first run up here, can you trade it if it goes into it again in here? Yes. That's a reclaimed fair value gap. That's the fact that the market's offering that again, it's reclaiming that fair value gap. But the wicks are doing the damage. So how can it run against you? How far can it run against you, rather? Well, it can trade into that volume imbalance. But if it does both and it starts to slam down, you really are being like a billboard sign, like on an interstate saying you're running low on gas, or if you're hungry, pull out on this exit here because we have the goods. It's a good thing to come this direction. Well, that's kind of like a neon sign saying that, like the bodies are staying inside this fair value gap. These are all things that you're going to annotate while you're watching price. What the hell's going on there? There you go. Okay, and look where the bodies stop. I mean, really think about this, okay? Think about the bullshit that people are going to tell you, and you've read in books, and you probably believe right now, if you're new, that markets are random, it's all buying and selling pressure. What the fuck are the chances of this candle's low and this candle's high that is my fair value gap? Midpoint is consequent encroachment. That means it's encroaching into this space again. It's consequential. It's likely to happen because therefore, if it's going to return back to it, this is what you expect. That's why it's consequential encouragement. Look where the bodies are. You see that? What's the wick doing? The damage. To what? To what degree is that wick going up against the underlying expectation? If you're going to trade with this pattern, what is the extreme of how far that wick can go? Well, look back over here. We have this short-term high. Does it go above that? Sure it does. But how high can it go above that, ICT? Look to the left. What do you have left? Volume imbalance. Deliver, one tick above, back down in. Consequent encouragement. Consequent encouragement. Fails to get to the consequent encouragement. That's what you're looking for. You want to see the next candle start to dive, go lower. Does it? Oh, wow. Now you can use this as an institutional order flow entry drill. Trades up into that gap, but you want to see that left open. You don't want to see that fill in, because if it can leave that open, guess what that means? It's a breakaway gap, and it's probably going to remain heavy, and it may afford you 15, 20, or more handles, something to that effect. And you're weighing out all of these potential delivery mechanisms. Your stop loss would be here. Here's your fair value gap, institutional order flow entry drill there. It spikes up, yes, but beforehand it trades down to the low of the new day opening gap on Tuesday. You would take a partial here. If you were holding on for more, chances are you probably would have got stopped out, because you would have definitely been moving your stop loss below the fair value gap. But you're paid. You're paid. And if you did something like that, if you had an expectation, maybe you're watching on the chart right now while I was talking, and you were looking at something like that, that's a plus. That's a win in your learning. Not that you should have been taking a trade, by the way, but if you're watching and observing it, relative equal lows. Top of the Tuesday. Let's see if it can spike down below that. You can make these drills as small and as minute as possible, and then looking and judging how does it behave. Or you can look at it from, I want to see it try to traverse over a span of 20 to 30 handles and study each one of them. And if you're looking at a 15-second chart, it gives you a lot of examples where you can do this and just study, what is it doing? How's it behaving? What levels is it respecting? How fast is it going away from a level? How fast is it drawing to a level? And or is it starting to stagnate? Is it having a hard time moving around? All these things are things that you need to be conditioning yourself to observe real time, because that's the experience that you're going to lean on when you're trading with real money, or when you're trading a funded account challenge, or when you're trading with a funded account with a prop firm, or if you're managing other people's money, because I have students that are delving into that now. And I'm not talking about Mickey Mouse money, like millions of money, which, my opinion, and you know who you are, just recently emailed me, my opinion is no comment. If you're choosing to do that, I have no input on that. I just know that it's very, 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 very stressful. If you're okay with that kind of stress, have fun. Don't do anything differently. You already know how to trade. Just trade with a whole lot less risk. But I don't want to comment anymore on that, because I'm not going to do that, because I just know that it's very, very stressful to manage other people's money with that level. But I think that's it. I gave you much more than I wanted to. You got another 46 minutes beyond what I said I was willing to do today. I spent a little bit of my birthday with you. See that volume imbalance? We wicked above that new day opening gap to what random level right there. And then we move back down to make another lower low. Watch right here, okay? Because all of this is pretty well balanced. If it remains heavy at 10 o'clock or leading into 10 o'clock, we might get some kind of a silver bullet. It could try to explore a little bit deeper in here. It doesn't mean it's going to keep falling out of bed, but based on what it's doing right now at the very moment where we're looking at it, I'd give it an opportunity to see that. I would rather see this stay open, or not open, but not traded too, because they're relative equal highs right now. I'd like to see it come back down and upset this. Where's that? Right here. Come down and hit that, and let everybody think it's going to drop, and then rake them across the coals and take it back up here. in the afternoon or going into the lunch hour. If I was making the market for NASDAQ, that's how I'd do it. But I'm just a demo baller. I don't know anything. I had fun today. I hope you learned something. If you did, I'd appreciate you giving me a thumbs up. I didn't check yesterday's live stream because it abruptly ended, and I had no control over that. They just turned off the stream, and I couldn't do anything about it. So I didn't bother trying to restart it. I just left it the way it is. I don't even know what the last few words were that I was saying, but I was pretty much done teaching. It was more or less me coaching and encouraging my son to just keep his focus on what it is he's trying to learn versus other people's opinions, whether it be about me or our ability to read price action as a community. It's hard to argue against this stuff when you see it over a live chart where it's being explained, and especially with this very, very small time frame like this. It's not random. It leaves the viewer with a sense of astonishment. It's impressive to see the prognostication that's available to you when you understand what it is it's doing and why is it doing it. And you're not surprised, you're not scared, you're not nervous. If I didn't know what I was doing, I certainly wouldn't be able to sit out here and explain this stuff over a live chart because I'd be afraid that it wouldn't pan out. And I think that if you listen to me, I don't sound like I'm animated at all, except for me making my dad jokes like I do all the time. Like that type of stuff that's synonymous with, that's my delivery mechanism. That's how I talk with you all. But I'm not in any way afraid that this stuff's going to fall out of style, like I mentioned before. It's going to keep working. And the time that you're wasting worrying about all that stuff when the market's presenting opportunities for you to make your grocery bill, to make your car note, to make your home rent or mortgage payment a little less painful or entirely cover it all. You're wasting your opportunity and time that could have been used to just go through the things that I'm teaching you to do, that I'm putting my son through. And he has to subject himself to doing these types of things. And when you see it pan out, it's really rewarding. And you don't need to have any profit yet because you're seeing progress. And that's why people quit trading. That's the number one reason why people quit trading, because it ain't the money that they made even when they gambled that keeps them wanting to trade. It's the truth that's deep down inside their core, that they know what they did to earn that money was absolute fucking luck. It was not skill. And they can parade it around on the internet like it was skill, but it isn't. It's not based on anything, but it just happened. Just like it happens for people when they buy lottery tickets or scratch offs or go to the casino. Those moments of where it just happened to be good for them. How can you attribute skill to going in and buying a scratch off lottery ticket or picking a random lottery ticket? You're in the line of however many people there are. And you just happen to get up to the register at that time, and then you ask the person to give you a random lottery ticket. You didn't pick the number, you just bought a random pick, and then it happens to be the winning ticket. You can't say that's skill. You just got lucky there. And sometimes, unfortunately, in trading, individuals, when we do things that we shouldn't do before we should do them, which is push a button on a live account and risk real money, when that happens and we have a positive expectation met where we hope to make money and it does, chances are you probably got out at a level you didn't want to get out at. And it's probably a level that is before or earlier than you wanted to get out. But because you've never made money before, this now is $1,000 or $500. And it's a lot of money to you because you've never made any money in the market. And then you close the trade. And you want to tell yourself and project that over the internet and say, this is my trade today. I made money. I made real money. What did you do? You're a demo baller like ICT or whatever. That type of behavior and activity is you literally lying to yourself and conditioning yourself to believe that you're prepared to continuously do that. When I teach a manner in which that you're going to learn how to do this. It's going to be harder than you want it to be. It's going to take longer than you want it to take. But once you get through it, you never have to go through that ever again. It's like riding a bike. I don't even know the last time I got on a bicycle, but I'm quite fucking certain I can ride that bike. I can pretty much go anywhere I want to go in it, okay, even in bad weather. So it's just like that. It's like knowing what it is that you're doing at your job, but your job's only going to pay you what your company is willing to pay you. But you have to go there every day the time they tell you to go there and stay there as long as they tell you to stay there, or you don't maintain that gainful employment. If you go outside of the parameters, you lose the job. That means you lose the income. That's like blowing your account in trading. Well, in trading, you have to start the same way. You have to submit to the boss. That's you, your future trading self that knows what they're doing. If you had a time machine, you go back in time, your future successful self would be telling you what I'm telling you. Listen, this is going to suck. It's going to be boring. It's going to be a monotonous task. It's going to be mundane and redundant, and you're not going to make any money initially for months, but stick with it. Stick with it. And if you do, the experience that you garner from it, you glean all this positive self-talk and you focus on the things that are beneficial to you, and you endure the things that are hardships and opportunities for you to learn better what you did wrong, but you don't vilify those moments. You don't say, man, I fucked that up. I didn't do that right. If I would have traded with real money there, I would have lost my ass. That's not how you record any observation in your journal. And that's not how you think about it either. You may be watching the tape, just watching and observing and saying, okay, here's an opportunity to see if the market behaves a certain manner here. But when it starts to turn on you, you should not feel any body symptoms, but you're going to be aware of it. I want you to think about it. When you start doing this, your breathing starts to speed up, or you start breathing through your mouth. That's the first indication that you're now feeling stress and anxiety. And if you don't check that, you'll develop that as a habit. And then when you start trading with real money, they will become full-blown panic attacks, which will distract you from watching the trade, even though the trade may still be viable and profitable if you just stick with it. But because it's real money and you're watching the ticker of the profit and loss little thing when you put a trade on, it'll tell you what your open profit or loss is. You're going to be fixed on that and not watching the candlesticks. And that's toxic thinking. It's toxic trade management. You're trading your equity and you're not trading price action, which is why you should not have your P&L being shown on the trade while you're first taking your trades, because you want to condition yourself to focus on the price action. Is the chart still delivering? Is it still doing the things you were thinking it was expected to do at the beginning of your trade before you even enter the trade? Because as long as those things are checking the boxes, yes, 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 who gives a shit what the profit is? Because until you close the trade or get stopped out, that number is not the number. It's going to be different. But you're watching it because you're getting a dopamine hit every time it makes a higher equity high. And then you're feeling adrenaline and cortisol when you're in drawdown and it was moving away from the highest point of the open trade equity. The highest point the profit was there. If you would have closed it, then you're going to start thinking, I wish I would have closed that. Are you watching price action when you're doing that? No. But what are you doing? You're feeding your subconscious fear, anxiety, regret, depression. So what are you going to tap into the next time you sit in front of a chart and you do another engagement of price action, entering a trade? Even if it's demo, you're going to revert back to that same toxic experience that you just left. So you have to be very guarded on how you manage your perception of yourself, how you manage yourself. You have to keep yourself calm. And there's a lot of things that I'm capable of sharing in terms of managing the stress and managing the anxiety that will initially be there. But it's mainly around your breath, like breathing slow, breathing through your nose, and also self-talk. Because if you have your conscience on talking to yourself positive, saying, okay, I want to see this is exactly what I'm hoping to see because this is supporting my original trade idea. But even if it turns around, it's okay because I have an idea that if it goes to this threshold, if this was a trade, it would stop me out and it would be minuscule in terms of any damage that would never take me completely out of the game. So I'm focusing on what price is doing right now, and everything is indicating to me that it's still moving in my favor, and every down close candle is supporting a move higher, or every up close candle is supporting lower prices. That still has a target to reach for. There's an inefficiency or relative equal low that I'm holding for. I'm submitting to that. I don't need to rush my stop loss. This is not the last trade I'm going to take. Everything I'm doing is I'm doing everything as I'm supposed to. I'm sticking to the process, and it feels good doing that. I have no anxiety about this because everything I'm doing is exactly pre-planned and pre-scripted. I know what this is likely to do, and I'm fulfilling my obligation and following these procedures as I should. There's nothing negative there, is there? You're being objective, you're reinforcing things positively, and you're canceling out any potential for negative stimuli to make you feel regret or fear or anxiety. And that's exactly what professional traders are doing, whether audibly, like I just did in the beginning. You need to do it audibly. That's why you have to have a space away from everybody else. You don't want anybody looking at you or listening to you and interrupting your train of thought. If you have animals and pets like I do, they got to be away from you. Every single time I've allowed my pets in, they've always been a distraction because I want to stop and pet them and love all over them. And if there ain't enough love for them, then they start jumping in my lap, and then all of a sudden I just missed an opportunity to take a partial. And then now what has happened? Man, if I would have took that partial off, where's my thought process? I'm not in the trade anymore. I'm in hindsight. I'm hanging on something I should have done but didn't do. So I end up usually closing the trade, or at least 50% of the trade. That's my mechanism for managing that because I've already been distracted and I could potentially have lost the plot. So to avoid that thing, no interactions. Okay. When my door is closed on my office, no one comes knocking, and my wife or children keep my pets downstairs. They're not allowed to come to the door and scratch and let me know that they want to come and see me. I'll see them when I'm done working or when I'm done doing like these live streams or lectures. This is time to focus. And that's how you manage all those things. But you're still going to feel it, and you're going to have to cope with it. And it's manageable, but in the beginning, you're going to feel them. You're going to feel all these scary thoughts and feelings and the report card mentality. Am I doing this? Am I going to be successful? The more times you expose yourself to watching price action without pushing a button, the more acclimated you are to eventually get to the point where you can do a demo trade. Because if you do anything with a demo account prior to spending time with reading price and tape reading and developing these skill sets within yourself and managing your expectations, managing your emotions, managing the stimuli that you're receiving by watching price, if it moves in your favor, when it's not moving in your favor, you don't know anything about yourself as a trader if you're brand new, if you haven't done this. You learn just how ill-equipped you are when you start trading with real money and you don't know how to trade. The only thing that does trading with real money, and I don't care if it's a $100 account, that's bullshit. That's absolute asinine bullshit to start trading with any amount of money that's real. Because now you have skin in the race. And the asshats that tell you should try to learn how to trade with real money, or you ain't really learned how to trade, that's an idiot. That is an absolute fucking idiot, because you're putting so much toxicity and negative thinking around every aspect of your decision making and execution and management of that trade that you are fortifying and guaranteeing that you're going to always trade in fear. Anyone that tells you different is a fucking liar, and they aren't making money. Period. That's the bottom line truth. The only way you're going to get to this point where you're completely detached, like a psychopath. There's no remorse for the victim on the other side of my trade. I have zero fucking empathy for the person that's on the other side of my trade. I have zero empathy. I don't lose sleep over them. I'm not worried about that. I don't care. I want them to lose. I want any person that's on the other side of my trade, I want them to fucking lose. That's the way we eat here. Like a lion, like wolves. They don't want to torture. They don't want to torture the animal, but they want to kill it because they want to devour it and eat it because they need that sustenance. They want to feed themselves. They want to feed their pride or their pack. Well, I have a family, and I'm fucking alpha. So I have to do things and make decisions that I can live with or have to live with. And the only way you're going to get through this without a conscience and moral dilemma is that everybody understands the risks. And if you've ever listened to me, you understand that it's hard. It's going to take you longer. It's not going to be easy for you. But once you understand you and what you're trying to do and you spend time in the charts, trading will get real easy for you. Because you're going to do a whole lot less trading. Whereas right now you want to do it every day, every session, multiple times. You think high frequency trading is an everyday appetite that you should walk into these markets with. It's not. You have to have a balance. And without balancing, I see, you're going to talk my whole way out of this then. Well, we traded down into this area here. We hit it and then went up for the relative equal highs. And it did that. What time is it? 10 o'clock. So there you go. So that's a pretty good read on a 15-second chart, right? I'm on 15-second, yeah. So how much could you have harvested from all the fluctuations today? That's your homework. Go through all of this price action, all of the previous price action after the 8:30 over here. How much of that could you reasonably expect for yourself? Low end it. Don't do the high end. Don't do the best scenario of where you could have got a perfect entry and a perfect exit. Could you have taken 25 handles out of this today? Could you have taken one 10 handle trade with little to no drawdown? Could you have taken 50 handles out? Explore that. Go into the price action and look for those types of things. And by doing that, unless you start seeking and looking for it, you're not going to discover what your ideal model is. Your ideal model might simply just be 20 handles a day. It might be 15 handles a day, and you're content with that. You're done. Others, it might be 75 handles, and it might take you 3 25 handle runs to get it. There's nothing wrong with that. But I don't want to press you into a specific locked in only this way, because my methods afford you flexibility. You can do whatever you want to do. All you have to do is know when the price is going to behave in a manner that is conducive for that to pan out. Look at this 15-second chart. This looks like it's like a whole week of price action. But every individual candlestick is 15 seconds. So everything you're seeing here is no different than what you would have looked at over the span of a week with a 1-hour chart. There's opportunities all the time. All the time. And I said I was going to show you that 1 second chart at 8:30, just to show you that it's pretty much untradeable at 8:30 when it first released. You either had to be positioned beforehand or you just missed it. So if you liked today's lesson and you learned something, the way you tell me is you have the thumbs up button. I don't notice your thumbs down if you do that, and it doesn't change anything when you do. I just look at the number. I don't look at the analytics page about it. Some people obsess about that. I think it's pointless. So this is a 1 second chart. That means every single candlestick in this time frame is represented by 1 second of open, high, low, and close. So right here, that's 8:30. Right there at the turn of 8:30 even. Notice there's no additional seconds or anything like that. And then we had this big run. So in 1 second, we traversed from 17,986 3/4 to 18,037 3/4. So in 1 second, boom, just like that, 50 handles or so. 1 second. If you're offside and you're trading one contract, man, you're getting pinched, aren't you? What happens if you're doing that 15 contract, trying to use a funded account? You're smoked, Well, let me get the refund this account link here and put that through. Gotta lie and tell my wife I had to buy a tire. Market drops down, rallies again. What is this? What's that right there? It's a fair value gap, but where is it? What's this level right here? Consequent encroachment on Wednesday's new day opening gap. So you have a fair value gap. It drops down 1, 2, 3 times. Rally. Trading up into Tuesday's new day opening gap. Trades back down into all of this, which is a balanced price range. What makes this a balanced price range? If you look inside, there you have, come on. Up, down, up, down. So it's painted, like say this is a wall in your house. The paint is coming off that roller really ample, really nice. And then you start going to another area where there's no paint yet. And you paint all this up here, and then you come right back down to where you finished before. You don't need to go deep into that. Why? Because this has all been balanced. And that's why you see it straight down to here. There's no need for it to explore into this range deeper. So what is it doing? Using quadrants of that same balanced price range. Put your fib or something like that and study that. See what it's doing? Everything is mathematically controlled by an algorithm. Everything. But it has to refer to specific things in price action that's already happened. All of these calculations are happening so fast because it's computerized. And it's cycling through time frames like real quick. And it's referring back to them really quick and making decisions and bang. But you think this is buying and selling pressure because it's easier to disbelieve that. It's easier to believe that, and it makes you sleep at night that it can't be this manipulated and controlled. Because if it's this manipulated and controlled, that means that they have strings on it and they can tug those strings anytime they want and have an outcome that they want to see. And that's all I'm trying to tell you. That's what it is. And you shouldn't be mad about that. You should be thankful that the markets are rigged. I am. I'm certainly thankful of it. I don't look at it like a casino and say, you assholes, I know if I go there, I'm going to lose my money. Because it's rigged to the degree that you're going to screw you. And if you start winning, they're going to escort you out the door. You're not going to be allowed to play there anymore. Ask any card counter in Las Vegas. They know them, and they're not allowed to be in there because they're beating them. Does that sound like it's a fair place to gamble at? No. If somebody can count cards, guess what? That's not easy to do. It's not easy to do that. So they have a skill set, and they're matching that skill set against your probabilities and your stacked decks, and the eye in the sky, and the rigged games that they use. But even on a smaller time frame, like a 1 second chart, you can see the same phenomena is repeating. Fair value gaps, trading to the levels, reacting off of them. Look how it's gravitating around the lower quadrant in the midpoint consequent encroachment. Look how it respected to here. A 1 second chart. Look how it respected there with the bodies. All this in here on a 1 second chart. And there's no algorithm. There's no way there's an algorithm. There's no way. You could never prove to me ICT there's an algorithm. Where's this algorithm at? I heard Tom Hugard. Somebody sent me a clip. Tom Hugard said, where is this algorithm? It's in your charts. That's the closest thing you're ever going to see. But if you don't want to believe it, because it upsets your narrative or your school of thought, it's just much more painless for you to say, no, I don't believe in an algorithm. Okay. You're not going to make me have the same thought process. That's for fucking sure. That's not going to happen with me. But look at this. This is Tuesday's new day opening gap. And you're looking for support resistance and failing at it. Because the support resistance lines you're putting on is what the books tell you to do. An old high and old low. And we target those things. You see how that's a completely diametrically opposed paradigm shift from what the losing crowd's doing over and over and over again, and the way they see price, and they're not smart enough to stop doing those things and reverse it. Just do the opposite of that. And then treat these levels as an opportunity to be attacked because there's orders above them. How hard is that to understand? For the life of me, I don't understand why anybody with any common sense can't see the truth in that. Versus, I'm looking for a pattern, a harmonic crossover, this, that, other thing, ratio trades, and all this horse shit. That's complicated to me. That's a complication. I went through all that dumb shit. And then I said, okay, what is the real mechanism here? Because when I put a trade on, if I get stopped out, I lost. So if I lost, somebody got that money. What were they doing to get to my money? Trading the other direction. Targeting my stop loss. Well, if that's the case, then it should start happening all day long. And there it was. Where do these things form? Time-wise. They're like traps and snares. They lay them down in the same spot all the time. You go out in the woods, if you ever go anywhere in the woods, you'll see a hide. It's called a hide where hunters will have usually like a tree stand or something to that effect. And it's sitting there. And they might put deer feeders or whatnot all around them. And they just keep feeding because they want the deer to keep coming around. And then when they want to show up to hunt, they go and they climb up in their hide and they wait for the deer to do what it's been trained to do. Keep coming here, it's food. Well, that's what the economic counter has done. It's a watering hole for the lions to wait for all the gazelles and the dumbasses to go down there and get a drink. And when they go down and get a drink, it's their last supper. And lions eat. That's what the economic calendar is for me. It tells me the time when the gazelles are going to the watering hole. It tells me when my next meal in the marketplace is coming to get devoured. And I can choose not to go down to the watering hole if I have something better to do. And that's a whole lesson in itself. Just because that there's time and opportunity for you to be in front of the chart doesn't mean that you should be. And that's maturity. That's you navigating your emotions. Look at this, man. Look how it's respecting these levels. Some random bullshit line dropped on a chart that the goobers will tell you, oh, eventually it's going to touch one of those lines. Missing the entire plot, like missing the whole point of what this is doing for you. It's giving you a means of determining where price should fluctuate from or gravitate to. This is the real support and resistance that you think that these books are teaching you. And when you try to do it, it's never the right resistance because it goes through and just keeps trading higher. Or it's never the right support. You try to buy it and it just right through it. It's demoralizing, isn't it? Consequent encouragement of the fair value gap, I told you. Hit the low of it. Boom. Look at these levels, man. This is 1 second. It looks just like any other time frame, doesn't it? Trading down to the low of Tuesday's new day opening gap. Look at that. There's no algorithm. There's no fucking algorithm, man. There's no way that these markets are rigged. You could never convince me of it. Oh, man. I'm telling you, every time I read somebody in somebody else's YouTube channel comment on that and say shit like that, tell me you're an idiot without saying it. That's exactly what you just did. Because all you have to do is study it and see it. It's there. How the fuck is the buying and selling pressure of all the traders in the world stopping these prices on a dime and respecting these levels that no one's ever talked about until I started talking about it? But you can go back in time before I taught them and you can find them in your chart, but you can't find Tom, Dick, or fucking Harry or mentors ever telling you about it. That's not me beating my chest and bragging. I'm just trying to show you that this stuff is valid. But the people that can't do it or made a very big argument about it online that there's no algorithm, now they're forced into a huge mob of all of you now that you know it. And some of you are very vocal. And I'm telling you, leave them in their ignorance. Just leave them in it. It's better for you to do that. Just let them stay stupid. They're just like that gazelle. only thing they can think of is I got to get a drink, and there's the watering hole. Let me go down there, and they're gone, ghosted. And where are we at here? What's that other level I told you it could gravitate to? Do you remember? That inversion fair value gap above the breaker. There's that gap I told you about. High, low, higher, high. This is where it can draw to if it goes above here. What's your chart show? Does your chart show this? What about that? Into that balanced price range that I showed you a little bit ago. So what I have in front of me when I'm trading, the only thing I worked with it today was the laptop that you hear me I'm holding. I swear in the Lord's name that all of my monitors that I have in front of me are all off. They're all off. But what I have on my charts is I have a 15-second chart, a 1-minute chart, a 5-minute, 15, an hour, a daily, a weekly, a monthly. And then I have a chart that I call a matrix, where it's a 5-minute, 4-minute, 3-minute, 2-minute, 1-minute chart for the NASDAQ, the S&P, and the Dow. And what I'm doing is I'm looking for S&T divergences on all of them at the same time. When I'm anticipating a fair value gap to form or a run above old highs, I want to see it diverge. One of them will fail. And that's like it's not a necessity for my trade, but it's just one of those things I like to see as a qualifier. It gives a little bit more quality behind my analysis where I already think it's going to do something anyway. And then it just behaves that way even more quicker and more strongly in my favor. And the speed usually really starts to deliver because I have that signature behind it. So you don't need SMT. Like, you really don't need it to be in your trades. But I like to look for it because it gives me that little bit of, okay, she's going to run now. And then she starts taking off, whether higher or lower based on my analysis and the SMT derivatives it forms. So I want you to go back and listen to this again, okay? And you'll hear me talk about how, if I was making the market, I would drop it down, take it down into that area, wipe that out, and then run above the relative equal highs. Earlier in the day, I told you that it's going to run up into here and run up into here if it goes above there. It's delivered all that, folks. I'm a fucking fraud, right? I'm a fraud. I'm out here doing this in front of you with a live data feed on the smallest of fucking time frames. 1 second. Can you get any smaller than 1 second? TradingView, I know you're listening now. Can you give me a time frame less than 1 second? Because if you can, I will trade that too. Okay, I don't have any access to that. Okay, this is what it is. So I don't know what else to tell you, folks. Either you're going to sit down and listen, take notes, and then just try it. That's all I'm asking you to do is try it. I don't have to give you a refund because you didn't pay for this. You're putting your time in to listen to the rules, what it looks like, how to practice it, and observe and capture the information, logging it. But all of this information doesn't have to be on the same chart. But you should, if you can, afford yourself a monitor, at least one extra monitor, where you can have this information on a blank chart without the other stuff there. But because I'm trying to teach you from the ground up, a lot of you only have one device. That means you're stuck with one chart, one screen. So it's a little bit harder. It's a lot more juggling between time frames and whatnot, and you'll have a little bit more stuff on your chart. But it's possible to grow from that. But you should have a chart that doesn't have like the fair value gap I have here, or that there, or these, or that. Okay? And I taught you yesterday that, I'm sorry, in this too, this shouldn't be there either. So you just have your new day opening gaps and new week opening gaps. I told you how many to have and why. I told you how to determine the bias yesterday, and I told you how to use these new day opening gaps and new week opening gaps in relationship to when you anticipate price spooling and moving directionally, and how to determine what direction it moves for. Well, we were here. Where is the clustering of all the new day opening gaps? Is it above or below that? Above. Here, here, and here. So where's price going to go? Up. Then I told you, look at that fair value gap right there. And then if it's going to go above that, it'll reach into here. It's done that. I would be done. If I was trading, I'm done. I'm not doing shit now. I'm not worried about the afternoon. I'm going to have a strawberry shortcake for a birthday cake today. I'm going to chill. I'm probably going to watch a movie with my wife in my theater. I'm going to kick back and relax and enjoy being 52. You can do this, folks. Do not let these little weasel nut motherfuckers on the internet talk you out of it, because it's costing you nothing but the effort you put in. If you give it a half-ass effort, you're going to get half-ass results. You have no excuse. You have no hindrance now. You have no reason to be fearful. You have no reason to doubt there's an algorithm. You have no reason to believe that these things aren't going to work, because they do fucking work. I come out here, I tell you what's going to happen over live data on the smallest time frames and feed that you all can verify. You all have live streaming of data, just like I do if you have live data. You watched everything before it happened today, again. All of these opportunities that was pointed out to you are not all the trades that were available. It's just that's the ones that I think that I believe that my son Caleb should focus on those initially. But you only need one of them. And the one that makes the most sense to you, that's the one that you're going to work for and look for in all of your logging, in all of your forward testing and watching and reading price action without demoing. And then when you get real good at noticing and when it's there and how to anticipate how it's going to form, it's like a fucking time machine. It's like you can predict tomorrow's weather better than the weatherman. You know the winning lotteries tomorrow. You know the outcome of a sports event. You're literally a time traveler, and you can forecast the future, and it feels like a fucking mutant superpower. And when you do it in the front of other people, they have to say it has to be fake. This guy has to be a fraud, or this woman is a fraud. She has to be a fraud. No one could do this. No one should be able to do this, but yet here the fuck I am. Enigma. Something that shouldn't be, but is. And I'm gifting this to you. I'm not selfish. I want to see you do well. I know you can do it. You just have to believe it too, and stick to the processes that I'm laying out in front of you. Just do that. Just simply do that. You have an advantage. I'm going to be doing this Monday through Friday, unless something is scheduled that I will tell you in advance, or if it's an emergency, something comes up. But I'm committing myself to my son understanding how to do this. So you're seeing it as he's intended to receive it. Do I look like I know what I'm doing? Does it look like I'm scared? Does it look like I am confused about what price is going to do? Does it seem like this is too good to be true? Because it fucking should feel like that. And that's how you know you're at the right place, listening to the right person. Because there ain't nobody else out there that's going to tell you what this price is going to do like me. And that is arrogance. And that is me telling you because I fucking earned it. Like it or not, that's the way it is. I saw a comment, and I'm going to close. The guy says, like it or not, ICT has a PhD in technical analysis. And the only thing I'm going to submit to that is a correction. I have a PhD in technical science, because that's what I've turned this into. It's a fucking science. We are the cult of winning. And everybody outside of it wants to be in it, but's too fucking afraid to drink. Drink deep. Jump in the plasma pool, baby. There's enough room for all of you, because it ain't changing shit. It's just going to be a bigger club of winners. And it can just keep going and going and going. And who knows who you're going to inspire? Who knows who you are going to inspire because of your success you found in this? All the doubt and trepidation you've had, I don't know if it works. We're going to find out. We're going to find out if ICT. Yeah, you're finding out, aren't you? You want me to dance the way you want me to dance. And I'm going to dance the way the fuck I want to dance. I have no problem being out here every single day. No problem whatsoever. And it's still going to work. It's still going to pan out. It's still going to happen. You think this is fun? Wait till you start seeing the entries and the profit targets getting hit, and the partials, and the pyramiding, all that stuff. You ain't going to be able to fucking sleep. You're going to be buzzing on goofballs. You think I put you to sleep with my talking? You're not going to be able to fucking sleep waiting for the next live stream. So with that, it's happy birthday, ICT. Give me a thumbs up if you enjoyed it, learned something today, and I'll talk to you tomorrow at 8 o'clock Eastern Standard. Waiting for it to be safe, aren't you?